Ladies and gentlemen, remember in the movie It's a Wonderful Life when there was a bank run? The one scene where there's a bank run and Jimmy Stewart, his character, is trying to prevent all of the customers, all the bank depositors from pulling their money out at the same time. Well, that good old fashioned bank run happened on Friday at the Silicon Valley Bank. Now, why is this important? It was a bank, $209 billion in assets, 16th largest bank in the United States of America. And many businesses no longer have the cash that they thought they had because they lost everything when this bank failed on Friday. Now, one of the things that the bank has, and most banks have, is the Federal Deposit Insurance Corporation, the FDIC coverage. And what is that? Basically, what that is that you are covered up to $250,000 on your deposits. And this is all included. So if you have $250,000 in a savings account and $250,000 in a checking account, and they're in the same bank, it only counts for one of those accounts up to 250,000. Everything beyond that you lose. So it's incredibly important to make sure that your bank is FDIC insured, first of all. But this is why many people don't believe that bank runs can happen, because really you need to remember that when you deposit your money with a bank, it's technically not yours anymore. Now, again, because of FDIC insurance, it feels as if it's safe. It feels like you can't lose it. But many businesses have discovered on Friday that they did lose it, and they lost millions. And again, a combined billions of dollars were lost on Friday. And they're never going to see that money again unless the government gets involved. And nothing says that the government's going to get involved, at least at the moment. Now, part of why this happened is the Fed Reserve has what's called a reserve requirement. And what is the reserve requirement? The reserve requirement is essentially a rule for the banks that says that you have to keep X percent of your deposits in the bank, just in case, so that if there was a run on withdrawals, that there'd be enough money in it. Now, the reason why this is important is because if, for example, the banks were required to have a 50% reserve requirement, then that would mean that they would have to hold 50% of their deposits. Now, that's important because for every $100 of deposits, if there is a 50% reserve requirement, the banks can lend the rest. This is how they make money. They can lend the rest of the deposits. And because of the velocity of money, that $100 at a 50% reserve requirement would be approximately 2 times velocity. So they can essentially take the deposits and create a doubling velocity so that they can make more money. They can lend it and re-lend it. If it were, say, a 30% reserve requirement, now that $100 is equivalent to about $320 of velocity. And if it's 10%, now that $100 has a 9 times velocity. So the banks can loan it and reloan it and reloan it. And since March 2020, the reserve requirement has been 0%. 0%. So that means that the banks can take all of the deposits they have, and they don't have to hold on to any of them. They can reinvest that and try to get the most that they can get from your deposits. Now, why is this important? Because the bank has to make money too. And when interest rates have been so low, it's the Fed funds effective rate going back 10 years, essentially zero. It popped up for a while up to about 2.5%. But then when COVID hit, it dropped back to zero again. And this makes it very hard for banks to use those deposits and make enough money to make sure that they are viable as a bank. Now, what else happened with this federal funds rate after 2022? The interest rates have risen at the highest, the quickest pace ever in history. So unfortunately, because of this, we don't know what's going to happen here, but things are breaking in the economy, and Silicon Valley Bank might just be the first. So what's a bank to do? They have to make money. So how do they make money on your deposits? Well, they relend the money as loans. Now, Silicon Valley Bank is obviously based in Silicon Valley, so they focus on a lot of startups, and startups, just by definition, are riskier. And a lot of these startups started to struggle during this slowdown, this economic slowdown, and started to default on those loans. Also, banks like Silicon Valley try to invest in something that's considered relatively safe, but higher interest. And one of them is these mortgage-backed securities. And basically what a mortgage-backed security is when the bunch of mortgages get pooled together and resold, packaged and sold as an investment. And the way that happens is that the individuals with mortgages that have a higher credit score get packaged in one, and lower credit scores that get packaged at lower. Now the banks, typically what they're going to do to make a little more money, a little more interest on your deposits, they'll invest in something like these mortgage-backed securities and invest in the higher interest or the lower risk, the AAAs, so that there's a greater chance that as they come to maturity, they'll get the interest that they expect, and everything will be fine. Now, investing in mortgage-backed securities works fine unless interest rates are rising. When interest rates are rising, these mortgage-backed securities have a discount to them if you have to sell them early. And unfortunately, because of the fact that Silicon Valley had fewer and fewer deposits coming in and more defaults with their loans, as well as more of the depositors pulling money out, they had to begin to sell these securities early. And that was part of the reason why they were losing so much money, billions, in fact. Now, if you were to take a look at the Silicon Valley balance sheet, you would discover that they weren't the most risk-averse bank out there. And in fact, if you just look at one ratio tells it all, the current ratio. The current ratio is current assets over current liabilities. Now, this is a liquidity test. This is to see how much money you have to cover your liabilities that are going to be due within the next year. Now, the larger the current ratio number over 1, the more current assets you have, the healthier the liquidity. So you want this number to be as high above 1 as possible. Just to give you an idea, perspective, the banks want to loan to companies with at least a 1.25 current ratio. Okay. So before we take a look at the top 10, I just want to give you an idea. Again, what do we want? The banks want at least a 1.25 current ratio. I want you to remember that, because I'm gonna just jump over to the current ratio calculation for Silicon Valley Bank. Current assets, 90.5 billion. Current liabilities, 186 billion. A 0.49 current ratio. 0.49. Banks want to lend to companies with at least a 1.25, and Silicon Valley Bank 0.49. And notice, if you go back to earlier in the 2009, they had a ratio where they had their current assets were higher than their current liabilities. But as time passed, and it appears that with the interest rates lower and things got a little riskier, they really started to go a little fast and loose, I guess. And now they're struggling because of it. Just to give you an idea, too, we have some of my clients, some of the banks that they use, M&T Bank, just to see what does M&T look like. So M&T Bank, current assets 165 billion, current liabilities 171. So they're at a 0.96. That's pretty good. Let's see, KeyBank is another one that a lot of my clients use. If we go to KeyBank, what's that look like? So 132 current assets, current liabilities 157. So that's a 0.84. Not as good as M&T, but certainly a lot better than Silicon Valley Bank. Now, if I were to just go back to the top 10 here and we pick a couple, JP Morgan, Citigroup, just to give an idea of what typical banks are looking like these days. So we got JP Morgan Chase. That's got a 0.84. And I believe I said Citigroup. Oh, there's a healthy 0.97. And what else? Got one more, maybe. Bank of America. Let's do that. Bank of America, 0.76, 0.78. So everything 0.76 or so through 0.97. That's where a lot of the banks are. Silicon Valley was a 0.49. There's a big swing there. So you want to be mindful that current asset, the current ratio matters in not only your own business, but your banks as well. Now, what do you do as a business owner? How do you manage this? First of all, when you deposit money in the bank, just remember it's not yours anymore. You're lending your money to that bank. And because of FDIC insurance, it feels like it's completely safe. But if you have money that had more than $250,000, it may not be. So first of all, make sure your bank is FDIC insured. Secondly, consider more than one bank to stay within that $250,000 FDIC coverage. So if you have $1 million, $2 million, you may want to consider having a second bank and possibly a third bank if you need to, if you're really concerned. Now, as we saw with M&T, even KeyBank, but M&T for sure, a much higher ratio. So it may make you feel a little more comfortable. You may want to get out of maybe smaller regional banks and move to larger banks. Next, have the capability to wire funds out of your bank. So you want to, if you need to get money out, you need a system that's going to allow you to get it out as fast as possible. And wiring funds is the quickest, fastest way to get your money out if you need to. And then also just always be mindful that bank runs are possible. Now, I don't think we're going to have a contagion with Silicon Valley Bank to other banks, but there's no guarantees here. And I guess we're going to learn a lot this next week on how the government's going to handle the Silicon Valley Bank. Are they going to let it fail? Are they going to let maybe somebody else come in and buy it at a discount? That might be possible. But be mindful that this can happen. This can happen to your bank, and focus on what's in your control. So be safe out there. You do not want to be one of those businesses that now are going to be struggling this week because they lost everything above that $250,000. And again, if you read some of the stories, there's a lot of businesses in Silicon Valley Bank that pretty much have lost everything. So thank you for listening, and please share this with others so that hopefully we can help as many people as possible. Take care.